Do you often use the moving averages in your analysis? Today I'll teach you a strategy with this indicator that will provide exponential gains if used correctly. I'm talking about the moving average crossing. So, get ready and stay with us until the end to learn everything. If you enjoy this kind of content, don't forget to like the video and subscribe, and also activate the notifications, so you won't miss any exclusive videos from Vector. That said, let's keep going. First things first, it is essential that you have in mind exactly what the moving averages are. A moving average is used to point the market trend, support and resistance zones, and price distortions. A great deal of traders use this technical indicator, from beginners to experts, whether to swing trade or day trade. But it is important to understand how it works. The moving averages are calculated according to the time frame you choose. Okay, but what does it mean? Let's assume that you are using a daily chart and you insert the averages with 9 periods set up. This way, the indicator will calculate the closing prices average from the past 9 periods, and, as we are in a daily chart, each time frame equals to 1 day. That is, an average of the other 9 closing prices. This is printed in the shape of a line over your chart, and, as we said before, it can be considered either a support or a resistance of the price, because it is an average from the last closing prices. That is, when the average is above the current price, it can be considered a price resistance. When it is already below the price, it is considered a support. In case you're wondering how support and resistance work, click on the card in the screen to access our Vector Guide playlist. Okay. Now that you've understood how averages work and that they can be considered supports and resistances, which averages should you use? Basically, we have two types of moving averages, the arithmetical and the exponential one. The arithmetical is the simple one. It is calculated exactly the way we have just explained, adding up the closing prices and dividing the sum according to your average time frame. And the exponential moving average works in a similar way, but it puts more weight in the last average periods. That is, in a 9 periods exponential average, you'll have in your chart an average with the last prices having more weight and moving differently from the arithmetical one. We can say that is an average with a more responsive movement. But that is no reason to worry. There is no right or wrong average for your analysis or a better or worst one. What you should do is test both averages and use the one that fits your trading style. Now that you have understood what is a moving average and which are the two main types, let's explain the crossing. As the name itself already says, an average crossing occurs when you are using more than one moving average in the chart and they cross each other. And the two type crossings, whether up or down, have their own interpretation. Okay, but how can I know if the crossing is up or down? Well, as said before, in this strategy you should use at least two different averages in your chart. One of them must be always shorter than the other, and it is into average that you should pay attention. If the shorter average crosses above the longer one, we say that it is an up crossing. When the opposite occurs, with the shorter moving average crossing below the longer one, we have a down crossing. You can see that you should always pay attention to the shorter average of your setup, because it is the one that will indicate which way the trend is going to. This happens because of the previous periods, according to the short average, have closings prices above or below the long average, that works like as price equalizer. Now that you've learned all the theory, let's take a look on Vector's screen where I'll show you how all of it works. Let's insert a moving average on Vector. To do this, right-click over the chart to see the options and then Insert Indicator. Here, we search for moving average. There is an option to insert it in a new window or over the chart. Choose Over the Chart. And let's set it up to 21 periods. Click OK. OK again, and we're done. Let's go back to the same place and insert a new moving average. But before, let's change the color of our first average. Click over it, and then, in this icon, let's choose orange and enhance its thickness. Now we insert another moving average. This time, of 9 periods. Then click OK. The next thing to do is to customize the shorter average too. With that done, we can start our analysis. Now that you have come this far, let's remember what we saw until now. The orange average is the longer one. Now in purple we have the shorter one. Now, let's remember what is the average crossing. The average crossing happens when two or more averages cross each other over a chart, where one of them is short, and the other one is long, indicating a possible reversion. This trend shift happens when the shorter average of your setup crosses the longer one, so you should pay attention to this one. When the shorter one crosses above the longer, it means a possible price reversion for an uptrend. If the opposite happens, it is a reversion for a downtrend. You can test these averages in distinct time frames, for example, 30 minutes or daily charts. Let's see another example. In this case, we're using the Bitcoin chart with a 30 minutes time frame. Realize at this point that the 9 periods average has crossed over the 21 periods average, resulting in a sharp price rise. And in the case if you had bought at this crossing and closed your position in the next down crossing, you could see your approximately profit. Let's see another example. Look at this crossing where the purple average goes above the orange one, suggesting a reversion of the trend. And following the strategy we're using, a buy order at the crossing and closing the position in the next crossing below, at this point would provide this result. See? It's simple. Now that you have stayed with us this long, let me give you useful advice only for professional traders. The triple average crossing. This crossing gathers 3 moving averages and has the goal of identifying more clearly the crossing to avoid false signals. To use this setup, let's insert one more average in our chart. The way to do it is the same as before: insert indicator and then search for moving average. But this time we'll add a 30-period moving average, which is calculated based on the closing price of the last 30 periods. Let's change its color to, and then change its thickness. Done. Now, see that the shorter average is still the 9 periods and you'll keep analyzing it. But now, the signals are considered only when the short average cross the another 2. When it crosses the middle one, keep an eye on it. And in the moment it crosses the longer one, the signal is activated. Let's see an example. Realize that here the 9 periods moving average initially crossed the 21 average. In this case, it is not recommended to start to trade. What you should do is wait for the next crossing. But next, the shorter average crosses the 30-period one too. And then the price starts to fall abruptly. Realize that the percentage between the crossing down until the next crossing can be visualized. Let's see another example. Here we can see a very interesting move. Realize that the shorter average crossed the other 2, but right away it crossed above the intermediate average of our setup. But the price stops going up and never breaks the longer average, proceeding to a downtrend. This case shows us that this was a false signal, but we're using a triple average system, we were able to protect from this market movement. So, tell us your thoughts about this strategy. For better examples, I used the 9, 21 and 30 period averages, but feel free to test other timeframes and check the ones with the best hit rate. If you want more videos with more trading strategies, like this one, subscribe to Vector's channel. It is very important for us to know your opinion about the classes. And don't forget to comment down here too. We'll read everything, okay?